Hello, everybody. Welcome to Clef Investments. Today is May 9th, 2025, and exactly a month ago, which is April 8th, 2025, I did my last tax harvesting because the market crashed in those days. We have talked about tax harvesting for a few times. Let's summarize our findings here. So first, we want to avoid S&P 500 index in your taxable account. This is because in your 401k or Roth 401k, maybe you are already buying some S&P 500 fund periodically. So any action of selling the same index in your brokerage account may trigger wash sale rule, which is very bad for your tax because you will lose those capital losses forever. And for more details, you can check this video. And also, I would avoid mutual funds in my taxable account. So this is because my broker, Interactive Broker, often charge a higher maintenance margin for mutual funds, which means the amount I can safely borrow against my stock portfolio would be less when the maintenance margin is higher. And also, mutual fund is different from ETF. When you sell mutual fund, you can only do that at the end of the day. For ETF, you can sell it like any stock. You can sell it at any time when the market is trading. And even before the market open or after the market is closed, you can still sell. Although when it's outside of the regular trading hours, you should be very careful, use limit order because the liquidity is much worse and you may not get a good price. So unless very necessary, please trade ETF during regular trading hours. And for the broad market index, which is similar to S&P 500, because you can no longer use S&P 500, you can use these four. So VTI, IWB, IWV, and SCHX. So if you look at the picture on the right, it shows the performance of VTI and compared to the other three, plus SPX, which is S&P 500 index. And this is more than 20 years of the past return. And you can see that they are all very similar. Actually, the one that is below all other lines is the S&P 500 index. All other ETFs performs slightly better than S&P 500. So all these are good replacement for S&P 500. And you can hold any of them in your taxable account. And if you trust technology-oriented index, then NASDAQ 100 is a good choice. For example, you could have QQQ or QQQM. And then there are other similar technology stocks, ONEQ, VGT, and XRK. Their performance are also similar. Actually, VGT and XRK, they are more concentrated on technology stocks, and their recent years' performance are even higher than QQQ and QQQM. Okay, so when you pick a ETF to invest for long term, the expense ratio, which is the cost you pay every year, is a important consideration. All these ETFs, they have a reasonably low expense ratio. So I'm listing all of them in the tables below. So you can see for the broad market index, there are very low expense ratios like 0.03. And the IWB and IWV are higher, but it's also in the reasonable range. On the table on the right, the QQQM are NASDAQ 100, and their expense ratio, as we explained in the earlier video, is 0.2 and 0.15. And also, for some others, their expense ratio are similar or cheaper. So that means it's okay to hold them for a long time because their annual expense ratio is reasonable. And different ETFs, they have different maintenance margin. which can affect how much you can borrow. So as we discussed before, when you calculate how much you can borrow, you need a few variables. So from the peak net liquidation value, you need to calculate after a max drawdown, what's the minimum NLV? And then from the minimum NLV, you calculate its margin rate. If you minus the amount you need to keep for the maintenance margin, you get the maximum amount you can borrow. So let's assume the maximum drawdown is 83%. This number is how much NASDAQ 100 has dropped in the dot-com bubble in 2001. So it's a very deep drop. And I hope in the future index does not drop more than that. If you are more conservative, for example, if you think it can drop by 90%, then in the formula, you need to replace the max drawdown with 90%. But the table below assumes 83%. Okay, so some ETFs have a maintenance margin of 9%. Some have 10%. So those are for S&P 500 index or QQQ, NASDAQ 100 index. But some ETFs are higher. They have 15% maintenance margin or sometimes 20%. But if you have some single stocks, their maintenance margin would be even higher, up to 30%. But if you really have single stock, this table may not work for you because for single stock, the max drawdown could be much higher than 83%. So it's a very risky thing if you assume single stock can only drop by 83%. But anyway, using the above formula based on different margin rate, you can calculate how much you can borrow. I have always been recommending that do not borrow more than 15% of your total portfolio if you have an index account. So you can calculate that if the margin rate is 9% or 10%, you can borrow about 15%. The last column shows relative to the 15%, you can borrow that amount. If the margin rate is higher, you can borrow less. So if the margin rate is 15%, you can borrow 14.4% or 96% of my recommended value of 15%. If the margin rate is 30%, you can borrow 79% of the 15%, which is about 12%. So you can see that even if you have an ETF that has a slightly higher maintenance margin, it doesn't really affect how much you can borrow by much. So you can still borrow reasonable amount of money as long as you are investing in an index. When you are doing tax harvesting, maybe you are switching ETF, which had a 10% maintenance margin, but after the switch, it has 15% of the maintenance margin. So you need to keep this in mind and check how much you borrow to make sure you are still in the safe margin. Okay, that's all for today. Thank you.